All right, I see a lot of misinformation. This is a trading video, and what I'm going to talk about is the most important metric in trading, and not just in stock trading. I think this is a concept. Like if I'm making information for my son, something for him to know for the rest of his life, this is probably a top 10 video. So key bit of information, and the idea, or the metric that I think is totally underestimated is volatility. You're like, oh my God, please. Anyway, but it's important to understand. So first things first, if I have, or if a market stall has bananas for $10 and the price for today stays at $10 and tomorrow and the next day and the next day and the next day, if I'm buying my bananas off him to sell on or to sell back, if his price doesn't move, there is zero opportunity. If for 1 minute bananas are worth $10, then $20, then $5, then $60, then $20, then $100, that is volatility. That is opportunity. It's if you buy if you want to trade anything, if the price doesn't move, there is no opportunity. Now, what does this mean? So let me put some pieces of the puzzle together. If you want to trade anything, it doesn't have to be stocks. It can be something in the, I'll call it the real world, property, computer monitors, whatever. To be able to make money and for the market to work, the price has to move. If no one's buying monitors at $100, the price has to drop to 90, to 80, to 70. If people are buying at 60, great, got some action. And then they can sell back when the price goes up to 80, to 90, 100. So volatility is absolutely crucial. I hope that's made some sense. So what do we do? All I see in media is, oh, it's really volatile. Oh, well, that's the best thing, because if you choose a world of no movement, there's no interest in that asset, in buying that product, that thing. If the price is moving around like crazy, that to me is opportunity. And when I hear about people saying, oh, I'm going to wait for it to settle down, or I'm going to wait for it to calm down, oh, it's too volatile. Wrong mindset. The more volatility, the better. Literally. The more crazy the price movements, the more opportunity. Because if you take it all the way back the other way, if the price isn't moving, there is no opportunity. So right now, for example, a lot of people are talking about crypto. And taking Bitcoin. Bitcoin's volatility is actually quite low now. So the opportunity in Bitcoin is also quite low. So the chances of people getting involved in the asset now are quite low, because there are many other assets that have greater volatility. And without knowing it, traders will move from a stock or a coin that has low volatility to one that has high volatility. Some traders might argue with me that there's a sweet spot for volatility, but I kind of disagree, because just on the simple zero volatility to lots of volatility, it's just, if you think there's a sweet spot, I think that says more about your the way you trade and your structure. Because a trader, whether this is stocks or out in the real world, you should always risk, the amount of risk you place on a trade is defined by the amount of volatility. So just for example, if it's a really low volatility product like the S&P, you can have a much bigger trade size than something with a high volatility, like a low price penny stock. That might, so the S&P, for example, is like, it has 1.7% range on a day, whereas a low price stock has a 10% range on a day. So I'm going to take a smaller position in the 10% moving stock versus the S&P that is likely to move around 1% a day. So it's not that something can be too volatile, it's just that your trade size is wrong. Anyway, so that's why volatility is important. And that's why you need to follow the volatility to be able to make money. And then the other bit that ties in beautifully with volatility is that from the options market, it makes a lot of people look stupid. What do I mean by that? Well, when Cathie Woods or some other pundit comes out with a price target, I'm assuming they don't know the options market, because the option market gives you a probability of that price being hit. Literally, a to one decimal place probability by such a time that price being hit. So when they come out with these outlandish Bitcoin targets, the market, if you believe that the market is perfectly priced at all times, because all information is in the price and in the implied volatility of the options market, which it must be, as defined. Because if it wasn't, someone would place the trade. So I'll show you now, for example, in Tesla or Netflix, I'm not sure which one we're going to look at, that there is a probability of that stock being 10% higher in 6 months' time. There is a probability of that stock being 5% lower. There's a probability, well, there's a expected range for that stock to trade in tomorrow, next week, next month. And the market is perfectly priced at all times. When people come out with outlandish projections outside that range, they really do just look stupid. It's not to say the market won't get there, but what they should say is, I predict Tesla's going to double in the next 6 months. I appreciate the probability of that is 4%, but I give it a 100% certainty, because otherwise they just literally really sound quite stupid. Anyway, let's have a quick look. All right, so here's Tesla. Now, so many traders don't get past the simple price chart. They'll cover this with 1,000 lines and Fibonacci's and Elliott waves and a million different things from the indicators, moving averages and all this stuff. And they'll define things as, oh, this is support and this is resistance, and here's support, here's going to be resistance, so now it's support. They come up with all this nonsense. If you go into the options chain now, for new people, it's quite daunting. But basically, here's the future, as in Michael J. Fox. We're going into the future, June 20th of this year, July 18th of this year, August, September, October, all the way. And then down here, we're into 2026. Now, this is just how many days it is away, so it's 9 days until it's June 20th, if you don't understand any of this. And this is for Tesla. Now, this is the options market. Now, a lot of your friends, no doubt, only ever look at this and they're like, oh yeah, Tesla's at 326, and as they swig another drink from their beer, they're going to say something like, I think Tesla's going to double. So somewhere past like 600, which is off this chart. And you can say, oh, by when? And they're going to say, oh, this time next year. So you could say, so June, this time next year. You go into the options chain. Now, just don't be daunted by this. This is the stock price. So the orange line just marks where we currently are, and then every $10 there's an options contract that can be traded. So if your friend, as he swigs a beer, says it's going to be double, so let's say 640. So this time next year, there's actually, this is what's called the delta. It's basically the percentage chance of it getting there. So there is a 26, you can say to your friend, well, actually there's a 26% chance that Tesla will trade $640 June 18th, 2026. It's as simple as that. So when someone comes out with Bitcoin going to 1 million or 3 million or whatever crazy projections they come out with, there is, if you get your options model out, there is literally a percentage that the market currently prices in for that stock or for that crypto. Just to give you a bit more explanation of it, because this is a very common layout. Over on the right here is the implied volatility. So right now it's around 68%, the implied volatility, which gives it a $50 up and $50 down expected range. Now, unless you've proven market pricing to be wrong, which means you'll be a gazillionaire, these prices are as good as it, or these expected ranges are perfection. So you can only expect between now and next month $50 up or $50 down on the Tesla price. Where were we? June of next year, this one. It gives, from now to then, it says, we think, the options market says, we think it can go $154 up, $154 down from its current price. And if you think that's nonsense, well, it's easy to make money from then. You can just go into the options contract and trade against that. So sometimes you'll find people that have never looked at the options market and they'll come out with outlandish projections. Well, there's actually an exact percentage of that occurring. So August, so in about a month's time, there's a 2% chance Tesla will trade 810. And you can place that trade. You could sell this call option, make 58 cents, if you think there is less than 2% chance of Tesla trading 810. Let's find a 10% mark. Here you go, 10% chance, 520. Will Tesla trade $520 in a month's time? If not, you can trade it. You can sell this options contract. 25% chance of 420. So is it going to put on 90 bucks between now and this time next month? You can sell that options contract and make money. You'll see here this brown line. Now this is that expected range. So you've got plus $70, minus $70 from the current price for the next month, well, till August 15th. And that is this, well, it's kind of brown, isn't it? This brown mark gives you the expected range of the Tesla price for the next month. And then the dotted blue line is the one standard deviation marker, and the second blue dotted line is two standard deviations. So it's not to say this would be classed as a one standard deviation move, and this would be classed as a two standard deviation move. And it will happen. It will move outside its expected range sometimes, and sometimes it will stay well within its expected range. But my point is, there is a probability for it, and there is something that can be traded if you believe this is massively mispriced. And when you see the pundits and their projections that are way outside two standard deviations, sometimes like three standard deviation moves, that's how ludicrous they seem, because really they're saying the market is mispriced. If they go outside the expected range with the timeline they give you, they're basically saying the market is wrong. So I think it's a really useful area. Even if you don't want to trade options, understanding when you're trading an instrument, understanding what the implied volatility is and therefore the expected range is actually really useful and really important. Just one thing you'll notice, positive drift means that by September 20th, or sorry, 19th of this year, they think Tesla, the market thinks Tesla will trade around between 350 and 355 because it's a 50% chance. So it doesn't actually price in the price of Tesla staying at 325, or well, we're 333 at the moment. It doesn't actually price that in. It's actually pricing it in to be at between 350 and 355. So that I always find that interesting when it's already priced up in the market. So that's also something to bear in mind. It would disappoint the market if it did not trade at 350 to 355 come September. So I hope this is interesting. I found it really daunting when I first loaded this up, but it's really not. It's just the number of days from today, and then within each drop down is what the share price could, or the share price staggered in increments and then just your price for the option, which you can ignore if you're not going to trade it, and the delta is the percentage chance of it being there. So when you get up your chart and you draw your lines, you know, if you're a technical trader, fundamental trader, and you're like, yeah, I think we're going to go past here, if it goes past here, you know, I'm then pricing in it getting to 4, you know, if you were technical, say, I don't know, 450, well, you can go, I can say, okay, 450 when, what, by the end of the year? Or say you're on like a 3-month trade, so October. So 450, I can say your trade has a 28% chance of happening. That for me is kind of a mic drop situation, because have you position sized according to the volatility of this product, and have you position sized with a 28% chance of this happening? Because if not, you are not trading the correct way.